In this example video, we're going to look at review exercise 13-14. So it says on January 1st, Tiger Company purchased 6,720 shares of Eagle Corporation's common stock when Eagle had 22,400 shares outstanding. It says that on the date, the following information pertaining to Eagle, so it gives us a portion of their balance sheet. And then it says during 2018, Eagle earned a net income of $120,000 and paid dividends in total of $48,000. And they want us to prepare our journal entries related to Tiger's share of Eagle's net income and dividends in 2019. So when we're looking at something like this, the first thing that you should always do is figure out how much ownership the company has purchased. So for us, in this case, they told us that we purchased 6,720 shares of Eagle Company's stock, and in total, Eagle Company had 22,400 shares outstanding. So that means we have a 30% ownership interest in Eagle Corporation. Anytime that we own more than 25% of a company, we follow what we call the equity method to record that investment. So that does a little different in terms of recording dividends. We actually record a portion of that company's income at the end of the period, and any increase or decrease in the fair value of any depreciable assets that that business has. It's because we now have a significant influence over that business. Anything less than that 25 or 20%, we do not. We just record, dividend income and all that type of stuff, just normal under those other transactions. But for us, we'll assume that we're doing this as of December 31st. So they told us that the company, Eagle Corporation, that we own 30% interest in, actually declared a net income of $120,000. So that means we get to increase our investment in our stock of Eagle Corporation. They are declaring $120,000 in net income, and we own 30% of that business. So we get to increase the value of our investment by $36,000, and we get to include that as what we call investment income of $36,000. They said they also paid a dividend, so we are going to get cash. They said in total they declared a $48,000 dividend. Again, we own 30% of that business, so that means we're going to get $14,400 in cash. But when we actually get a dividend and we are a significant shareholder, it actually reduces our investment in that company of the $14,400. When you're thinking about this, think about looking at what happens on a statement of retained earnings, for example. When we think about that, what do? We add in net income and we subtract away dividends. Same type of thing is happening here. I'm a big enough shareholder that when they declare net income, it's going to positively impact my investment. However, when that company is declaring a dividend, that is going to have a negative impact on my investment. I'm basically swapping one asset for the other. The other thing that we do under the equity method is that we look at the company's depreciable assets. So we compare the fair value to the book value. So in this case, the fair value is $620,000. Book value is at $600,000. So we have a $20,000 increase between the fair value and the book value. Again, we own 30% share of that, and they tell us that there's an 8-year remaining life of that asset. So what happens here is we reduce, we call that investment income. So again, the $620,000 fair value minus the $600,000 book value times the 30% share that we own divided by the 8 years remaining. That does us for $750 in investment income that we're reducing. And we have our investment in stock for our Eagle Corporation. That also is going to go down by $750.